Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Amazon agrees to buy satellite operator Globalstar in an $11.6 billion deal, all about spectrum.
Plus, we speak exclusively to Lucid's new incoming CEO, Silvio Napoli, as the company announces a fresh injection of capital and deeper robotaxi push.
And the US Treasury Department looks to use Anthropic's Mythos AI model to find vulnerabilities in its own systems.
But first, we check out the markets, which have actually been on a tear. 10 straight days of gains for the Nasdaq 100. We haven't seen this sort of 11% charge. We haven't seen this longer stretch of gains since all the way back to 2021. Today, the hope is there that we'll have a second round of talks between the US, between Iran, maybe it happens in Pakistan, and whether we are not managed to put an end to this conflict. The market is getting ahead of those hopes, and we're currently seeing real gains, up $3 trillion in terms of market cap over the course of those 10 days, Ed.
Okay, we have some M&A, and it's confirmation of a deal we've been tracking on the show for a little while. Amazon to buy Globalstar, $11.6 billion deal. The offer is basically the equivalent of $90 per share for Globalstar in cash. We're at just around $80 right now. So there's a premium on where the stock's currently trading, even with that big jump on confirmation of the deal. What's it about? It's about direct to sell from satellite. There's some spectrum in there. There's some strategy in there. It's time to get the details, Cara.
It certainly is. We get more of them from Bloomberg senior deals reporter Michelle Davis. And just the timeline here, because we knew this asset, this Globalstar business, was in play. When did Amazon start getting interested?
So we've heard that Amazon started getting interested last year, and Globalstar is an asset that's kind of been out there for years. People have always talked about it as the key, kind of the jigsaw piece in the puzzle that, you know, if you bought it, because of all of its spectrum, it would help you get up to speed and kind of dominate the satellite market. And so that's what it really is about. It's the spectrum. We heard that SpaceX had also looked at this asset last year. Of course, Amazon prevailed. And, you know, both of these players have been racing to dominate the space-based connectivity market. And Starlink is clearly ahead. But what this does is it really accelerates for Amazon their plans to be a formidable competitor to Starlink.
Michelle, really interesting one for the deals team, right? Like Amazon, the tech giant that it is, has never gone that big on M&A. But I think I'm right in saying that Globalstar, pending close, etc., would be its second biggest ever deal. You know, what do we make of, and what was the reporting around the offer, how competitive it was, and how Amazon really wanted to go for this?
You're right. I mean, this is Amazon's biggest deal since 2017 when it bought Whole Foods. Amazon's been known to kind of go after different parts of the market, you know, everything from healthcare to movie studios to now, of course, this big spectrum satellite play. And what we were hearing is that Globalstar was really looking for a value above $10 billion. And the deal that was announced today is at a huge premium to, you know, more than 100% premium to where the stock was trading when the leak first hit, you know, last October. And so, I mean, it clearly shows there aren't that many players out there that can afford to spend this much money on something like this. But if you want to win in this market, that's what it takes, clearly.
And the advice they've been getting from banks is the way in which that they structure this, not just in terms of premium, but in terms of what's on the offer. It's either shares or indeed it's straight up cash.
Exactly, yeah. So it's a mix of stock and cash. There's a 40% cap on the amount of cash that shareholders can get, and that means they'll get up to, or a cap of $90 per share, up to 40%. The way that works is basically a few days before the deal is going to close, shareholders will get to elect what they want. Do they want, you could say, I want all stock or I want all cash, because of course Amazon stock is valuable. But at the end of the day, assuming everyone elected all cash, the most you could get is 40%, 40% in cash. So it'll be prorated depending on what folks elect.
Really appreciate you breaking down the deal structure. You know, this has been out there for a couple of weeks. Now it's confirmed. In that period, what was industry saying about this, right? Like the big picture is, Amazon's going to go after Starlink. But there were actually, if you look at the specific details, you know, in terms of LEO, they have a lot of existing assets, Amazon does. What was our read on the strategic play from Amazon?
So Amazon really needed the spectrum to really accelerate its desire to get into that direct-to-device market, which it said today it's going to do in 2028. And what that'll do is it means, consumers will be able to get text, video, data, voice using satellite service rather than cell towers, kind of like a cell tower in space. But what it does is helps Amazon catch up. They haven't been able to launch as many satellites as SpaceX has. That's one of the biggest reasons why they've been behind. But this piece is really complementary to everything that they do already have.
Bloomberg's Michelle Davis with the reporting. Thank you very much. So what does Amazon get out of the deal? Let's get the reaction. According to Bloomberg Intelligence, the company's $11.6 billion agreement gives it a foothold in the direct-to-cell satellite market, along with access to valuable spectrum, narrowing the gap with Starlink and SAT Space Mobile. Bloomberg senior telecom analyst John Butler joins us with his research. Let's start with the rationale. Why do you think Amazon's doing this?
It's all about the spectrum, Ed. There's a lot of spectrum out there, mostly in use by terrestrial wireless carriers. And I stress the word terrestrial because the FCC will only allow most of the spectrum now that's accorded to wireless services to be used on a terrestrial basis. But there is a band called mobile satellite service, or the MSS bands, that allow for direct communication from satellite to cell phone. And Globalstar owns some of that valuable L and S band spectrum, as it's called. So in my mind, this deal is all about the spectrum. It's not about the satellites that are up there. GST actually has a pretty thin constellation as satellite networks go. So
the big coup for Leo, Amazon's Leo, potentially, is Apple as well, John. So how much does this make this a cementing of that? How do we see Amazon really going neck and neck now with the likes of SpaceX?
Well, SpaceX has a big lead here, Caroline. I mean, they have both broadband and direct-to-cell satellites. Their fleet numbers 10,000 satellites, 650 of which are direct-to-cell. So Amazon has a lot of catching up to do, both on the broadband front and the direct-to-cell front. My suspicion is what they'll do is throw more funds into GST's next-generation satellite development program. They're developing these next-generation sats called, I believe, C3s. They will be higher capacity. They'll be able to offer full wireless services for the most part, voice, video, and browsing. And so that's the key here is Amazon has
John,
deeper pockets.
Let me jump in here. That is key because there is a really big present-day distinction between broadband and the capabilities that Starlink offers you and what you can do with direct-to-cell. Direct-to-cell is text messages right now, right? And not a lot more. Could you just go through the basics of that distinction?
Yes, so broadband satellites offer high-capacity links. So if you look at Starlink, they have 100, 200, 400 megabit plans. The users are static, they're not moving. And so those satellites are really designed specifically for that. Direct-to-cell is a different animal. You need to go from the satellite directly to a cell phone. And cell phones have very, very low, their signals are very low power. So you need specialized satellites with big antennas to do that. Starlink and Amazon have the funds to develop those next generation satellites. Again, Amazon has a little catching up here to do. AST is also a big player in this market. They have very sophisticated satellites. So I guess I would say this, Ed, the race is on.
Race is
It'll
on.
be interesting.
M&A is certainly helping jumpstart it. John Butler of Bloomberg Intelligence. It's been great to have your expertise, your analysis today. Let's get a broader take on the markets. There's certainly a bit of a tech M&A feel to it till today. Lei Chu is with us. AllianceBernstein, pleased to be welcoming you, portfolio manager. And we don't want to do individual names, but what's notable is that there is some desire to be making purchases at this moment, despite the volatility in the market. What do you make of M&A coming to the fore?
Well, as There's definitely the race is on. I think that's a good description of the current state of the market. There are a lot of disruptive changes happening across different themes. AI is one of them, but there are other things as well. And because of that, I feel that incumbents, in particular, with such strong balance sheet historically, they are looking to bolster their war chest, because when disruptive changes happen at this pace, everybody is spending, and you can think of spending as in CapEx, but M&A is another factor that plays in, and then sometimes can help you get a lead. But I would say the bottom line is the race is on. Everybody's playing both offensive and defensive, and that's what makes it an interesting and exciting market to invest.
How have you seen the disruption and the race in space, in defense tech? Has that been something you've been leaning into with the funds?
Yes, and for our portfolio, we have been looking at disruptive changes across, and space and defense tech is certainly one area that we're seeing tremendous amount of capital flowing into it. And so while the market has been spending a lot of time, and AI is certainly part of it, where a lot of capital has flowed into it, space and defense tech, it is an area, particularly in developed markets, we have actually underinvested in and perhaps underestimated. So when we look for secular changes longer term, these are two buckets that we see sustainable growth trends.
Lei, bear with us for 1 second. We have some breaking news on the Bloomberg terminal. Disney is announcing it's cutting 1,000 jobs, the first wave of layoffs under new CEO Josh D'Amaro. The layoffs are company-wide, but they will fall particularly hard in marketing and the marketing department, which is being consolidated under new leadership. An interesting one, Disney shares up around a percentage point right now in response to this, but 1,000 jobs in the context of this company, Caroline, is a relatively big move, but it's a company of 230,000 people. So we're going to continue tracking that and bring you a fuller picture later in the program. What you were just saying, Lei, is so interesting. When you've come on this program, we've been talking in the context of the AI race on terrestrial-based assets. For many people, the next wave, particularly running inference at the edge, is going to be above our heads. And so in the context of what we went through, Amazon, Globalstar, satellite communications generally, what is the AllianceBernstein thesis on that?
I think from our perspective, when we think about it, a lot of attention has been clearly focused on the GPUs at the core and then on the training side. And this year, with the rapid adoption of AI, as we have seen the token adoption, we see increasing evidence the edge is taking off, and the data center infrastructure, as we see it, it's rapidly evolving. So if you look at from an investment perspective from our fund, we're seeing a broadening out. We're seeing the players, the incumbents and new entrants thinking about what the future of infrastructure would look like. We talked about the shortages at various levels. We talked about the training, the power.
Right.
But increasingly, we're also seeing, just even at the commodity level, across the board, we're seeing the adoption. And that gives us confidence that there is increasing confidence in the CapEx spend, the sustainable trend of that. And then beyond that, in terms of different buckets that will benefit from it, we're really seeing the broadening out of different ways that we're trying, because at the end of the day, AI is incredibly capital intensive, data intensive, bandwidth intensive. So everything has to catch up. There are just a lot of investment opportunities across the board.
Have you done an assessment on the viability of the economics of orbital data center?
I think it's probably too early to say that, to say definitively viable or not viable. But that said, we're just using today's revenue numbers. But this is really about the rebuild of the future of infrastructure as we see it in a digital world. So I would venture to say some of the changes that we have seen thus far in terms of how rapidly we have hit an inflection point in AI adoption. Just look at the ARRs of some of the new entrants. It's staggering how fast it's actually ramping. So if we take that as a starting point and then we look out, I would say, if historically in technology and when there's disruptive trends, what we have seen is on the short-term basis, it looks like everything could be overbuilt. But if you actually look out on a long-term basis, as consumption is taking off, we actually don't have enough capacity to address all the needs of the future. And in this particular case, it's really about looking out long term and having a secular view and then say, what do we see as the future, and then invest accordingly. They're not all going to be winners. There will be some losers. And so we actually have to be very selective as well.
Nimble. And therefore, how much do you divert towards the energy focus, towards the actual infrastructure, rather than just the deployment and the applications?
Yes, we actually just look across the board at all times, right? All investments, when we look at it, we think about, I always say, we don't look at valuation as the first starting point, but ultimately we do look at the long-term potential and look at how much the stocks have been bid up, and then how sustainable it is, the growth and the margin profit pools that we're looking at, and whether that justify the valuation. So that at all times it does require you to be more nimble as an active investor in this kind of environment.
Well, we love having you on, Ed.
Yeah, Lei Chu of AllianceBernstein back on Bloomberg Tech. Let's turn to some whiplash in the markets and a story we brought you yesterday. NVIDIA has denied that it's trying to buy a large PC company. The report from the website Semi-Accurate sent shares of two of the world's top PC vendors higher yesterday. Dell climbed over 6.5%. HP was up over 5.5%. That was Monday after we brought you that original report. Today, after that denial, we're back down on both of those names, a little softer, 3% on Dell, almost 2% on HP. And it got people talking, Caro. We brought you the original report yesterday. We've had the denial. I think we just wanted to close the loop on that one.
Yeah, some M&A on, some M&A off, keeping us up to speed. Meanwhile, coming up, we're going to hear from Lucid's incoming CEO, Silvio Napoli, on the EV maker's latest injection of capital. It's a lot. This is Bloomberg Tech.
OK, shares of Lucid are all over the place, frankly. We're down almost 6%. In the pre-market, when news broke, up 12%. We opened higher in the main Tuesday session. The company has named former Schindler Holding chief Silvio Napoli as its new CEO. The EV maker also announced $750 million in fresh investment from its two largest backers, Uber and Saudi Arabia's Public Investments Fund. I spoke with Napoli about the new capital and the company's path forward. Listen to this.
Discussing with PIF, discussing with the chairman, was an absolutely vital element of my decision-making.
They were involved in your talks to become CEO of Lucid?
We have a chairman of the board who's from PIF. Of course they were. And again, equally, I was keen to understand their engagement. Today's announcement is a confirmation of their continued support, or their belief in Lucid as a company and in its future. And therefore, absolutely, their role is absolutely key. And they are a very savvy investor. And it is, for Lucid, a competitive advantage to be able to rely on that type of support in a very competitive market.
What did the PIF, the chairman, but the PIF's representatives convey to you on what their priorities are, how they see the to-do list for you at Lucid?
Yeah, this type of discussions, of course, where there was an element of strategic discussion to be now taken further, but the most important element of that was their belief, their willingness to bring on board someone like me with industrial global experience in turning around, in growth, in businesses around the world, combining industrial manufacturing and service, and building a brand, we saw it the same way.
I've been reading about you, as discreetly as possible, been asking people about you. You are about discipline, reality in your approach, cost discipline as well. You look at all these projects that Lucid has. Some of them may or may not carry forward, right? At the Investor Day, a prototype of a specific robotaxi design. How much is that on your list to look at the existing plans, existing products, and say, let's just focus on the main thing?
It's very high on the priority. As a matter of fact, I believe deciding what we don't do is going to be as important, if not more, than deciding on what we do. I'm an engineer myself. I can see the excitement engineers experience when given a new challenge. And so our goal will be to channel that excitement in the projects that have the highest return for our shareholders, and then taking them one at a time.
A lot to talk about with the incoming Lucid CEO, Silvio Napoli. Great interview, Ed. Meanwhile, coming up, Oracle, it's agreed to purchase fuel cell power from Bloom Energy as it scales up for the AI boom. More on that next. This is Bloomberg Tech. In the race to build out AI infrastructure, Oracle is moving to solve that power pinch by striking another big deal with Bloom Energy for its fuel cell power. Bloomberg's Brody Ford has more. The share prices have reacted, Brody. And what is it that Bloom Energy brings that others don't?
They bring power, right? I mean, that's the big bottleneck. Right now, you can really get the chips, you can get the customers certainly, but in a lot of cases, you just can't get the power to get these big data centers running. And so what Bloom Energy offers is fuel cells that's going to be a lot quicker than if you were going to go out and try to buy some gas turbines yourself. And, you know, Oracle has clearly said that they are willing to pay what is likely a pretty hefty premium here to get power online quickly. And again, they have the giant contract with OpenAI. They're on the hook for a number of gigawatts within a year or two. And so Oracle's ready to give out the cash to Bloom to make sure that this plan goes accordingly.
That scale is interesting because we talk about the hyperscalers and then Oracle from a capacity standpoint, and we cover in great detail the hyperscalers securing long-term energy supply. Talk a bit more about Oracle's broader strategy on making sure it can power all of that capacity.
Effectively, Oracle promised something pretty large to OpenAI. They promised 4.5 gigawatts in a pretty unprecedented timeline. And so, yes, they are not a traditional hyperscaler, but right now they are building at hyperscale. They have a similar deal with a company called VoltaGrid, which offers kind of gas turbines as a service, and they're paying them a lot of money, right? I mean, out of their Shackelford campus in Texas, that's one data center, they're paying over $1 billion per year to power it. And so we have to imagine this is a similar scale deal, and that's why the Bloom shares are so happy this morning.
Right. Bloomberg's Brody Ford, thank you very much. All right, so the state of play is that the NASDAQ 100, which is a very tech-heavy index, is up for a 10th straight day. Best run of gains since 2021. Despite everything that's happening around the world, technology is plowing on. Coming up, we're going to speak to Denny Fish, portfolio manager on the Global Technology and Innovation team at Janus Henderson Investors. Somebody that has funds in the billions and billions of dollars, is zeroed in on the biggest names of technology, and I hope can tell us why tech powers forward amid all these geopolitical crises. It is halftime, and this is Bloomberg Tech.
Welcome back to Bloomberg Tech. A check on these markets that are continuing to ramp higher. We've had 10 straight days of gains in the NASDAQ 100. We'll dig into that in a moment. But today, what fuels us higher? Optimism that we'll have a second round of peace talks between the United States and Iran, and we're up more than a percentage point on the NASDAQ 100. Amazon, M&A, spending $11.6 billion to buy a satellite company, and Globalstar jumps almost 10%. And that's on the back of a nice little premium being paid by Amazon. Move on and have a little look at what has been an extraordinary stretch for technology amid all the volatility, geopolitical angst. We saw the S&P 500 shake off those losses of the conflict yesterday, and now we have a 10th day of gains, $3 trillion added to the NASDAQ 100, Ed. The question is, can we continue?
Let's get more on the perspective in the markets with Denny Fish, portfolio manager on the Global Technology and Innovation team at Janus Henderson Investors. Something we looked at yesterday is one case study was Intel, right, and gaining more than 50% over 9 sessions. But the NASDAQ 100 is on track for 10 straight days of gains, while we have a war in Iran, while energy prices are spiking. Given the technology sector has momentum, what is it that investors are basing that on, Denny? What are the factors they're assessing in their optimism?
Yeah, I think the primary factors are that regardless of what the geopolitical environment looks like, and, you know, obviously I have to couch that a little bit because if it got extreme, this won't hold. But the trends that have persisted for the last 3 years because of the advances and expected advances in artificial intelligence just won't slow. And so unless you have a belief that we are starting to plateau in some form as it relates to the models, or that there's some other major constraint that's going to constrain our ability to actually advance these technologies, you kind of have to participate in the investment cycle, because this could go on for several years. And having covered technology or worked in the technology industry for over 30 years, these trends persist much longer than investors could ever imagine. And this is the most profound technology shift in our lifetimes. And I think that's why the market has quickly come back to the stocks that were working before the conflict actually started.
Denny, before the conflict started, software wasn't working. And actually today it is. But that hasn't been consistent in the last few days, particularly when you think about Mythos, the latest models coming out of Anthropic, and what that means for software writ large. What's your take on how beaten up the sector's got?
Yeah, it's really hard, because the fundamental thing that's going on right now in software is that the market, broadly speaking, is questioning the terminal values of the companies. And once you start questioning the terminal values of the companies, it's really, really hard to disprove a bear case. And the reason that this just continues to get questioned, and we've seen it, really, it started in mid-December when, with the launches of Claude 4.5 and Codex from OpenAI, those were step function changes. And I think in an environment where investors were expecting maybe more moderate increases in capabilities, we saw a step function change. And then with 4.6 from Claude, we just saw another step function change. And what's important is, these context windows are getting much longer. The agentic capabilities are becoming amazing. You combine those two things, these products now, these models can do things that humans, the best humans, can barely do when it comes to software development. So really what it comes down to then is what is going to be the barrier to entry for software, and how sustainable are the competitive advantages of the existing incumbents. And I think one of the challenges is that not only do you have threats from the models at the moment, but all these capital market cycles generally kind of look and feel the same. And as we get into 2027, 2028, we're likely to see an environment where you see a whole slew of agentic-first software companies that have been funded in the venture community over the last 3 or 4 years that are then going to be coming as scaled enterprises growing really fast. And typically that's a more attractive environment.
And so don't buy into software
investors
at these levels, Denny? Like, how do you make that decision? Or is it safe to be with the picks and the shovels, with the energy, with the infrastructure, the chips?
I think it's still safer to be with the picks and shovels and the infrastructure that's building out for these models. And I mean, if we just look, I think a great data point that we just recently got, if you read Andy Jassy's shareholder letter from Amazon, and he just clearly lays out what's going on within their infrastructure. And once you really understand kind of the constraints that we're still facing and the returns that these companies expect to get over time, you can start to get more comfortable with that. But, as far as the eye can see, I was just in Asia. I mean, we are supply constrained in AI infrastructure, likely, well through 2027, maybe into 2028, depending on, what components or, that you're looking at. But nonetheless, this build-out's going to continue. And I think we're going to continue to see the same thing that we've seen the last 3 years, where we get closer to the end of the year, and then the expectations around CapEx, whether it's the hyperscalers, enterprises, or governments, just continues to exceed expectations.
So to illustrate that point, the top 2 holdings in the 2 biggest funds that you're across, Denny, are NVIDIA and then TSMC. And the state of play so far in 2026 is that the NASDAQ 100 is up modestly, and the SOX, is massively outperformed. I think going back to Caroline's last question, when does that change? Which point in time do you adjust your holdings to reflect more dominance of the software names benefiting from the investment?
Yeah, I think a couple of things would need to happen. I mean, the reason that AI infrastructure continues to work is, number one, the fundamentals remain quite strong and continue to exceed expectations. And that's not just TSMC and NVIDIA. That's the memory complex, that's optics, that's energy. I mean, we can, data center infrastructure, you can go, down the whole list, and they all continue to participate. but you would either need those fundamentals really to start to slow, lower than what investor expectations are, or the valuations to blow out to levels where then you just get really uncomfortable at what your return could be despite really strong fundamentals. And so far, fundamentals continue to be strong and valuations are reasonable across a lot of the ecosystem. And you contrast that to software, for example, where maybe fundamentals are stable. Maybe they're not declining yet, but as I mentioned, you have terminal value risk. And then you actually, if you're looking at these things and comparing them on, say, like a GAAP basis or adjusted for stock-based compensation or the things that a lot of generalist investors would do, the valuations actually might not look that attractive in many cases. And that's why I think you have to be careful. We're still investing in software, to be clear, but we're taking what I call a rifle shot approach versus a shotgun approach when we think about the names that we'll invest in. And more likely than not, the better place to be invested is in infrastructure software that's based on consumption, that's really going to benefit from this build out as well, versus the application space.
Danny Fisher, Janice Henderson, we so appreciate it as you've been on the road a lot. Thanks for checking in. And look, let's check out another area that NVIDIA is injecting some life into, quantum. Now, we understand NVIDIA is launching its world's first family of open source quantum AI models called NVIDIA Icing. That's named after a mathematical model. And really, this is designed to help researchers, enterprises build quantum processors actually capable of running useful applications. Look at the stock market reaction. D-Wave, IonQ, Inflection, which is part of this partnership in particular, all up and to the right end.
Okay, coming up, the Treasury Department's tech team wants access to Anthropic's Mythos. We'll discuss the AI model's cybersecurity impact next. This is Bloomberg Tech.
The US Treasury Department is seeking access to Anthropic's Mythos model so it can begin hunting for vulnerabilities. Now, that's according to a source. Anthropic has warned the powerful model may be capable of powering cyber attacks and has released it only to a limited group of institutions thus far. Let's get the latest. Bloomberg cyber editor Jeff Stone. Is it as powerful as all this? Is there a good reason why part of the government, we might say while the Pentagon is currently in a legal fight with Anthropic, should be getting access to the model?
Anthropic hasn't released this model publicly, which is really important for everyone, especially in the general public. Cybersecurity researchers don't have access to this tool, so we can't independently verify that. Initial feedback has been that this tool is quite powerful. This is the kind of thing that it's essentially what Anthropic describes as the ultimate kind of red team tool, that if you unleash it within your systems, you're going to use it to find as many bugs and vulnerabilities and potential points of exploit before the bad guys can.
So according to our source, right, the Treasury Department want access to it to identify vulnerabilities.
Right.
Is there any more flesh to that you can take us through, Jeff, what the Treasury Department would do with it? There's also the background that Treasury Secretary Bessent was part of the official group that warned Wall Street about taking this seriously, right? That's right.
The Bessent meeting that he had with Fed Chair Powell is a really important piece of context to this. When they summoned all these Wall Street leaders to a meeting with them in Washington to urge them to say, hey, you should unleash this tool. You should try to find your own kind of flaws and vulnerabilities before outside attackers do. You know, at that time, we know that Treasury and some government agencies were in discussions with Anthropic about using this tool. They want it for the same reasons that they're encouraging so many of their partners to use it.
Bloomberg's Jeff Stone with the reporting. Thank you very much. Let's get more on the capabilities and impact of Anthropic's Mythos. Let's speak with Jaya Balu. She's the Chief Operating Officer and Chief Information Security Officer at the AI cybersecurity firm ISLE. A week ago, I spoke to Mike Krieger, who leads Anthropic's labs team. And in the context of Mythos, he was saying, when you have a model this powerful, you can't actually isolate one capability. But what's so confusing about that is we are only talking about Mythos' ability to identify vulnerabilities quicker, at great expense, but that's the very narrow use case. What have you made of that?
Well, so actually it was never in doubt that we can use AI to discover vulnerabilities. And at ISLE, we've been doing that since August 2025. We found all of the vulnerabilities in something that's been a very hard code base, like OpenSSL. We've been finding those vulnerabilities. So using AI to find vulnerabilities is not a unique capability. What I think is interesting about Mythos is it's supposed to be the most powerful model yet. And I have to say, like, there is a contention here. I disagree with that, because I think one of the things you see is that, you know, the vulnerabilities that they've actually surfaced and disclosed are not impossible to find, not with a closed source model like Mythos, but also with small, tiny, open source models. And that's incredibly significant, because Mythos has now been restricted use to only like 40 companies. They are incredibly deterministic about who gets access to it. And I think that what we should expect is that if we really want to maintain a state of security, specifically with open source security vendors, then we need to make sure that they also have the capability to do this. So one of the things that we're really intent on is releasing something open source that is comparable to finding those same kind of vulnerabilities. And we've proven that we can actually do it.
How can you, Jai, do that safely? And do you think, therefore, that this is being done safely from a Mythos general purpose model perspective, or is it more hype that's happening around it?
Well, I think there's always, you know, I think with all of this stuff, there is always a degree of hype. And the real effect, you can only actually validate it when you have access to the model and you compare it to other models. But if you just take a look at the vulnerabilities that they disclosed, we can confirm that we can find those vulnerabilities, not with a closed source model from Anthropic, but an open source model like GPT 5.4. So, and that is the tiniest model that we can test with, and we can confirm that we can find those same vulnerabilities. And the reason to make this more widely available, this open source tiny LLM model, is this is something that I believe that we should always do, because defenders now globally are, you know, worried about who else can build this. If we've already proven previously you can do this with open source, it's just a matter of time before someone else figures out how to do it. So without making it open source, we're actually giving defenders a disadvantage. And I think the real issue is, how can you get defenders up to scale globally, not just 40 companies in Silicon Valley, but everybody on a level playing field in order to defend their stuff. So open source maintainers need to be able to find their own vulnerabilities in order to fix them.
Are attackers already looking at these smaller open source models? What have you seen, particularly as we are in the midst of a global conflict where Iran has very sophisticated cyber attackers, at least?
Yeah, I think the best example that we saw is the recent example that was, you know, hit by towards the Mexican government, where you saw a bunch of compromise happening because of AI, because of an attacker using AI to hack the government of Mexico. So I think, like, we are definitely going to see more of this. I worry about, again, the ability for people who are trying to build like foundational internet capabilities to have access to things, to find issues in their own code base and then defend them proactively, versus having a sort of small community only have access. I think we need to democratize this, because the building blocks of the internet are democratized. They are in the hands of everyone.
Jai, this is the view of Bloomberg Intelligence, our in-house analysts, right? And that is that Mythos on paper, because you quite rightly point out the limited scope of access, lacks the capability to replace leading cybersecurity providers like yourself beyond vulnerability assessment, right? It's good at identifying memory corruption, logic vulnerabilities. Do you accept that's where its limits end? Because the conversations I've had every day for 7 days is that this is a model more capable than any we've seen before.
And you know what? I think Mythos is actually doing, let me just maybe caveat this by saying I think they're doing a really good job. I think it's hard to, though, for us to actually validate some of that it's the greatest model ever, unless you can actually do it, because we can reproduce this with free, and I want to emphasize the word free here, free open source models. The smallest models are capable of finding the same thing. So it's not about the model. Although Anthropic makes it about the model, it's really about the system and the scaffold and everything you built around it. Because what we see is that this capability is quite jagged. So it's not good at everything equally as well. It's good at some things, like you pointed out, but it's not good at everything. And that's just something that we also see in the open source model. But given enough open source model, you can highly parallelize all of this stuff. So instead of relying on one exceptionally intelligent model, you can take this kind of raw intelligence capability, farm it across many models, and then actually find more. This is something that we've proven. We can actually find bugs that Mythos has missed. And we're doing this together with the open source community. For example, Hugging Face models and GPT 5.4. And again, like doing this for free means that there's a certain degree of asymmetry right now that's being held by Anthropic. That asymmetry will decline. And to your point, we will have other actors also capable of doing this. So it's about giving defenders the leverage here to figure out their own issues and fix them.
Jaya, it's great catching up with you. Jaya Balloo, Avile, we really appreciate your time. Now coming up, US residential electricity prices, they have spiked in the last 5 years. And how much blame is AI getting for that jump? What's it going to mean for the midterms? More on that next. This is Bloomberg Tech. The rapid build-out of AI infrastructure has seen a spike in energy prices. Wholesale electricity in areas with significant data center activity has risen as much as 267% in 5 years. Now, that's making the cost of electricity for the 2026 midterms, well, what the price of eggs was in the 2024 election. That's the focus of the latest Bloomberg Big Take. And one of our reporters on it, energy reporter Josh Saul, is here with us now. And I want to clear something up first and foremost, because is the bad rap coming to data centers, the right target right now, in amidst oil price issues, amid just supply-demand constraints, the upgrade of the utilities more broadly?
People are really angry about their utility bills. Data centers are part of the reason that those bills are getting higher, but they're not the whole reason. There's other things like investments needed for an aging grid, overall inflation. But when you ask people, when I was in the Lehigh Valley in Pennsylvania, when I would ask them about their utility bills, they would say, I'm so mad about the data centers. They would go right to that.
Right. Josh, there is, when it comes to data center impact on any given zip code, there's not in my backyard, right? NIMBY, that's one movement. But specifically with energy prices and how it relates to the midterms, how do we measure the movement of the electorate in how they feel about this issue, in how it might sway votes in key races?
The NIMBY issue is more about green space. It's more about what's right next to you. People worry about power prices, but the way that the power prices travel across the grid, whether you can see a data center or whether it's 10 or even 100 miles away, it's still going to be affecting your power bills.
And look, it's affecting Japanese power bills, it's affecting UK power bills, and some of them are data center related and some of them are also energy and import related. But take us to Pennsylvania and take us to whether or not this is being deemed more one side, more Democrat issue, more Republican issue, because of course it is the administration, the current administration, that is all in on data center expansion.
It's shaping up as an anti-incumbent issue. So there's a Republican incumbent in the Lehigh Valley, and people are angry about their power bills, and often that anger is taken out on an incumbent, whether it's a local representative in the Lehigh Valley or whether it's President Trump.
I want to thank Bloomberg's Josh Scholl, who has the big take, and it's a must read. Let's get back to Disney, the story that we broke at the top of the hour. Disney is cutting around 1,000 jobs. That's according to Bloomberg sources. Bloomberg reporting that the cuts will be company-wide, but impact marketing most. This would be the first layoffs under new CEO Josh D'Amaro, who took over from Bob Iger in March. Separately, Bloomberg is reporting and has seen a memo from Josh D'Amaro to Disney staff that says that they will start eliminating roles in some parts of the company, and they've begun notifying those impacted employees. The stock didn't really move when the story broke. Carrie, there's been reports on this in prior weeks, but a big piece of news.
Yeah, more agile, technologically enabled workforce is what they want. Well, we talk about that technology and the enablement, and it does it for this edition of Bloomberg Tech.
Yeah, recap on the pod. You know where to find it. A lot of important markets, news, technology conversations. That's where you find it. From New York and San Francisco, this is Bloomberg Tech.